My name is Elias Hussein, and tonight we're talking about a company that almost nobody outside Wall Street has heard of, yet it quietly sits behind a massive portion of global trading. Not a bank, not a hedge fund you see on TV, not a Silicon Valley startup, a trading firm. And according to multiple estimates, this single firm has been involved in around 1 out of every 10 stock trades in the United States. Let that sink in for a second. Because last year, this company reportedly generated more trading revenue than giants like Bank of America, Citigroup, and even Goldman Sachs' trading desks. 3,000 employees. Average pay reportedly around $1.4 million per person. No celebrity CEO doing interviews on CNBC. The company is called Jane Street. And the reason people are suddenly paying attention to them is because of something strange that started happening in the Bitcoin market. Something so oddly consistent that traders began screenshotting it every day. Almost the exact same time, right around 10 a.m. Eastern, just as US markets were getting into motion, Bitcoin would suddenly drop. Not a tiny move, 2%, sometimes 3%, over and over and over again. For months. And when traders zoomed out and looked at the pattern, the timing was so precise that it triggered a question that nobody likes asking about markets. What if this isn't random? What if someone is pushing it? Now, before we go any further, I want to be very clear about something. There is no confirmed proof that Jane Street manipulated Bitcoin. But the structure of modern markets has created a situation where a small group of firms have enormous influence over price flows. And once you understand how that system works, the theory suddenly doesn't sound as crazy as it first appears. So let's rewind for a moment. Jane Street was founded in 1999 in New York, but unlike traditional hedge funds, they operate as what's known as a quantitative trading firm. That means algorithms, statistical models, massive computing power. Their trades often happen faster than human reaction time. Milliseconds. Sometimes microseconds. And their strategy is simple in theory, but incredibly complex in execution. Find tiny inefficiencies in markets and exploit them at scale, across stocks, options, ETFs, currencies, commodities, crypto. Wherever there is price movement, they're there. But what makes Jane Street particularly powerful isn't just their speed. It's their position inside the plumbing of the financial system. Because in several of the biggest ETFs on the planet, Jane Street acts as something called an authorized participant. And this role is far more important than most investors realize. Here's why. When someone buys an ETF, whether it's the S&P 500, gold, or Bitcoin, they aren't buying the underlying asset directly. They're buying a share of a fund that holds the asset. For the ETF price to stay close to the real asset price, someone has to constantly adjust supply, creating shares, destroying shares, balancing demand. That job belongs to the authorized participants, and only a handful of firms are allowed to do it. Think of them as the gatekeepers between Wall Street money and the actual asset. Now here's where things get interesting. Jane Street is one of only a few firms allowed to perform that role for the largest Bitcoin ETF in the world, BlackRock's IBIT. Which means when billions of dollars start flowing into Bitcoin through the stock market, Jane Street is sitting right in the middle of that process. And that position gives them capabilities that ordinary traders simply don't have. For example, most investors cannot short sell something unless they borrow the asset first. But authorized participants have regulatory exemptions in certain situations. They can create ETF shares as part of market-making operations and sell them in ways others cannot. That alone creates powerful opportunities. But there's another detail that most people miss. When large institutions report their holdings, they usually disclose long positions, what they own. What they don't always have to disclose are the complex derivatives that might completely offset that exposure. So you could look at a filing showing a firm holding hundreds of millions of dollars of Bitcoin ETFs and assume they are bullish, when in reality they might be fully hedged, or even positioned to profit if Bitcoin falls. From the outside, You simply can't see the whole picture. And this lack of visibility is where suspicion starts to grow. Because around late 2025, market observers began documenting those strange daily Bitcoin moves. 10 a.m., sharp drop, liquidations triggered. Then later, recovery. Again and again and again. For casual investors, it just looked like volatility. But for traders watching order flow, it looked like something else entirely. Timing, precision, execution, almost like a strategy. And if a firm had both the capital and the market access to execute such a strategy, it would look exactly like this. Now imagine the following scenario. You accumulate Bitcoin quietly. Then you open large short positions in derivatives markets. At a specific moment of low liquidity, you release a wave of selling pressure. The price dips. Leveraged traders get liquidated. Their forced selling pushes the price even lower. Your short positions become profitable. You close them. Then you start buying again at cheaper prices. The market stabilizes, confidence returns, and the cycle resets. If someone could repeat that process consistently, they could generate enormous profits while the market appears to simply be moving sideways. Again, this is a theory, but the mechanics behind it are very real. Crypto markets are heavily leveraged. Billions of dollars of positions can be wiped out by relatively small moves. And professional trading firms understand exactly where those pressure points exist. But the Bitcoin pattern alone might not have triggered such attention, if Jane Street didn't already have a controversial history in other markets. Because in 2025, regulators in India accused the firm of manipulating the derivatives market using a coordinated strategy. According to the regulator, the firm pushed prices one direction during part of the trading day, and then reversed the trade later to profit from the move they had just helped create. The investigation resulted in hundreds of millions of dollars being frozen, and the firm being restricted from certain trading activity. That case alone made global traders start asking questions. Because the strategy described in the investigation sounded eerily familiar to what people believed they were seeing in crypto. Morning movement, later reversal, profit from volatility. Now again, correlation does not prove causation, but when patterns line up, people start digging deeper. And that digging led to another explosive development. A lawsuit tied to the collapse of a massive crypto project. A collapse that wiped out tens of billions of dollars and triggered one of the biggest chain reactions in digital asset history. And somehow, Jane Street's name appeared in the story again. But what happened next is what truly sent the internet into overdrive. Because the moment that lawsuit became public, something very strange happened in Bitcoin. The daily 10 a.m. drop stopped completely, and within 48 hours, the entire crypto market surged, which raised a question that traders still debate today. Was the pattern coincidence, or had the spotlight just forced someone to step away from the controls? Because if markets are truly free, patterns like that shouldn't exist for months. But if markets are influenced by the largest players in the room, then what we call price discovery might actually be something very different. And that brings us to the deeper story behind Jane Street. Not just the trading, not just the lawsuits, but the network of people, power, and events surrounding one of the most mysterious firms in modern finance. And once you see that bigger picture, the idea that a handful of firms can move entire markets doesn't sound theoretical anymore. It sounds structural. The strange part of this story isn't just the trading patterns people noticed. What really pushed everything into the spotlight was a lawsuit connected to one of the most destructive collapses in crypto history. Because long before people were debating Bitcoin charts and morning price drops, the industry had already witnessed a financial disaster that erased tens of billions of dollars in a matter of days. The project was called Terra. At its peak, Terra's ecosystem was valued at around $40 billion. It was one of the fastest growing experiments in decentralized finance, attracting investors from all over the world who believed they had found a new kind of stable money. The system revolved around two tokens, one called UST, which was designed to behave like a digital dollar, and another called Luna, which acted as the balancing mechanism that kept the entire structure functioning. The idea sounded brilliant on paper. If UST ever dropped below $1, traders could swap it for Luna, reducing supply and pushing the price back up. If demand increased, new tokens could be created to maintain stability. As long as people trusted the system, it appeared to work perfectly. But systems built on confidence can collapse incredibly fast once doubt enters the market. And in May of 2022, doubt arrived all at once. Roughly $85 million worth of UST was suddenly dumped into a liquidity pool on a decentralized exchange called Curve. That amount alone wasn't enough to destroy the project, but it was enough to disturb the delicate balance holding the peg together. The price slipped slightly below $1. That tiny crack changed everything. Traders began questioning whether the peg could hold. Some pulled money out just to be safe. That selling pushed the price further down, which triggered the algorithm designed to defend the system. More Luna was created. But creating more Luna meant diluting the value of the existing supply. As the price of Luna started falling, confidence collapsed even faster. Investors rushed to exit before things got worse, which forced the system to create even more tokens to try to maintain the peg. Within hours, the spiral was obvious. Within days, the entire ecosystem imploded. UST, which was supposed to stay at $1, dropped to pennies. Luna, once worth around $80, effectively went to zero. $40 billion vanished. People lost savings. Crypto funds went bankrupt. Shockwaves spread across the entire industry, and the chain reaction that followed eventually contributed to the downfall of major companies like FTX. For a long time, the collapse was explained as a flawed design, an unstable algorithm finally meeting real market pressure. But years later, legal filings introduced a much more controversial possibility. According to a lawsuit, a former intern connected to Terraform Labs, the company behind Terra, later joined a large trading firm. The claim suggests that individuals with inside knowledge about how Terra functioned may have shared insights after leaving the project. Those insights, if they existed, could have been extremely valuable. Because knowing where a system is fragile allows traders to position themselves before it breaks. The lawsuit alleges that certain trading strategies may have been built around understanding how Terra would react under stress. If that information was used to structure trades ahead of the collapse, it could mean some market participants were prepared for the disaster, while the public had no idea what was coming. It's important to emphasize that allegations in lawsuits are not proof. Cases like this take years to resolve, and the full story often turns out to be far more complicated than the first headlines suggest. But the mere possibility that sophisticated firms might identify structural weaknesses in markets and profit from them raised serious questions. Because if a firm has enough capital, enough data, and enough access to liquidity, it doesn't always need to predict the future. Sometimes it only needs to understand where the pressure points are. And that realization brought attention back to Bitcoin. Unlike Terra, Bitcoin doesn't rely on an algorithmic peg or a fragile feedback loop. Its supply rules are simple and transparent. No one can print new coins on demand to defend a price level. Yet the market where Bitcoin trades is still part of the broader financial system. And that system has changed dramatically over the past decade. When Bitcoin first appeared, most trading happened on small exchanges populated by early adopters and tech enthusiasts. Institutions largely ignored it. Wall Street considered it too risky, too strange, and too small to matter. But once Bitcoin's value climbed into the hundreds of billions, the financial industry began building ways to participate. Futures markets were launched. Options followed. Large custodians began offering storage services. Then came the biggest shift of all, spot Bitcoin ETFs. The arrival of those ETFs opened the door for enormous pools of capital. Pension funds, asset managers, and traditional investors who would never open a crypto exchange account suddenly had a familiar way to gain exposure. Billions began flowing in. But ETFs don't operate on blockchains. They operate inside traditional finance. That means banks, brokers, liquidity providers, and authorized participants all play roles in the process. These entities manage share creation, hedging strategies, and large trading flows that help keep the ETF aligned with the price of Bitcoin. And firms that operate at that level see something the public doesn't. They see where money is entering, where leverage is building, where liquidity is thin, where price could move quickly. This doesn't automatically mean manipulation. In many cases, it simply means efficient markets. But it does mean the largest trading firms have a structural advantage in understanding how markets behave. Retail investors see charts after the fact. Professional firms see the machinery behind the charts while it's happening. That difference matters. Because once a market becomes large enough, it stops being driven purely by belief or narrative. It becomes driven by capital flows, hedging strategies, and liquidity dynamics. Bitcoin didn't escape the financial system. In many ways, the financial system adapted itself around Bitcoin. Which brings us back to the strange timing that first sparked curiosity. For months, traders noticed a repeated drop near the same moment each day. Then legal news connected to a major trading firm surfaced publicly. Suddenly, the pattern disappeared. Prices surged. Billions flowed back into crypto. Maybe it was coincidence. Markets often change behavior unexpectedly. But for many observers, the timing was hard to ignore. And it reinforced a broader lesson about modern markets. Power in finance rarely looks dramatic. There are no villains pressing red buttons in dark rooms. Instead, it looks like algorithms executing trades faster than human reaction time. Models analyzing liquidity across dozens of exchanges simultaneously. Firms deploying billions of dollars in strategies designed to capture fractions of a percent repeatedly. Individually, each action seems small, but together they can shape entire markets. The real takeaway isn't about one company or one theory. It's about understanding that markets today are ecosystems where technology, capital, and information collide. The largest players operate with advantages that didn't exist 20 years ago. Faster data, deeper liquidity, global reach. And teams dedicated to finding patterns before anyone else notices them. For everyday investors, the lesson isn't fear, it's awareness. Because despite all the complexity surrounding modern markets, one fundamental property of crypto still remains unchanged: ownership. When someone holds digital assets directly, outside centralized intermediaries, control stays with them regardless of what happens in trading venues or financial products built around the asset. Prices will move, markets will evolve, institutions will enter and build new systems. But the underlying network continues operating the same way it always has: blocks being produced, transactions verified, and rules enforced by code rather than by any single firm or authority. And that tension between decentralized technology and powerful financial institutions may end up being one of the defining stories of this entire era of markets.